Welcome to episode 40 of the Confessions podcast. My name is Chris Sweeney, otherwise known as the Alchemist in these parts, and we're joined today by a very special guest. But before we bring him in, let's go to our old sparring partner, the man that can see around corners, the guru in St. Bart's, Hugh Hendry. How are you, my friend?
I'm well, and my promise to anyone listening or watching is that I'm going to try and remain rooted to the spot, close to the microphone, so that we make it a more pleasant experience. Now let's bring in the secret sauce.
The secret sauce. He is a hedge fund manager from London. He is also a former colleague of Mr. Hugh Henry. It is Sir Tom Roderick. How are you? Welcome back to the show.
Hello. Thanks for having me on both. Pleasure to be with you both again. I've got to say, it's fantastic weather here in London. I'm not sure it's quite as nice as St. Bart's, but the sun is shining, and hopefully our conversation will shine just as much.
The question is, are you wearing trousers or shorts? You don't have to prove it, but have you bared the trousers, or are you really sitting there shorts, or are you naked from the waist down?
No comment. I'll just have to try and remember not to stand up.
Talking of which, when I was editing last week's show, to my great horror, Chris, I think you were wearing Peppa Pig men tights.
Percy Pig, not Peppa Pig. Percy Pig, the Marks and Spencer sweet for anyone in the
edible
UK.
Tights.
Well, no, they weren't edible. They're based on sweets. There's nothing wrong with them. They're quality. I'll wear them next time on the show if you want. I'm not embarrassed by my choice of trousers.
You're not embarrassed, but we are.
Well, what can I say? What can I say?
Chris, but the other pertinent question, like you say, around these parts, if I am the asset capitalist and you are the alchemist, what does that make Tom?
I don't know. That is a difficult one. I never actually thought about that, Tom. Tom, what is your moniker? What is your nom de guerre, shall we say, in these parts?
That's a very good question. I don't think a man is really allowed to come up with their own nickname. So any suggestions I'm open to, either from you guys or from the audience.
Well, indeed, yeah. Please come in on the YouTube comments page. I think of your Twitter page and your handle as being, it sounds like you're a DJ, but when you're on the show, I think of you as Saint Thomas, who provides calm and rigor and good analysis to the madhouse, which is the Asset Capitalist Show.
Exactly. Well, one thing I want to ask you about the madhouse. We've talked recently over the last few weeks about Gabe Plotkin. He's the man in charge of Melvin Capital, and Hugh gave him a bit of a shellacking, shall we say, the hairdryer treatment. He was not happy, and Gabe's taking it to heart because Gabe has told us all as investors the past 17 months have been an incredibly trying time for the firm and for you, our investors. I have given everything I could, but more recently, that has not been enough to deliver the returns you should expect. I now recognise that I need to step away from managing external capital. It's over for Gabe. What do you think about that, Hugh?
I was almost breaking down in tears. I mean, I can see the bass, but really the violin would seem to be more appropriate. I've given it all, people. I've been there for you. I've really, really tried. Oh my God. Like the last 18 months have been really, really, I'm too far away from the damn microphone. The last 18 months have been really, really so hard. It's like, but Gabe, am I right in saying the 18 months before that, didn't you earn $4 or $5 billion for yourself? Like that must have been really hard. So how do you call this the decision to quit? Is it as the very expensive PR team in Registered to spread the message would like us to believe that it's a noble gesture? He's fallen on his sword. The results were so shocking that honor would insist that he walk away. Or is it actually the reverse? Is it just another galling demonstration of just how wrong the system of rewards and remuneration is the system that we've labeled in terms of the hedge fund manager. Heads, I win. Tails, I win. You lose. This is a situation where heads, he won, and with the AUM, and we've spoken about Chase Manhattan the third, and they make billions. They don't make but like when I got 2008, God, what did we make? We made nothing, like 10, 20 million or something, which, believe me, was then distributed to build the business into something different. So it says nothing about that. And so, but walking away from it, what he's saying is my take on that, and why it kind of makes me cross, is he's saying, listen, I'm not willing to dip into my, you gave me $4 billion or $5 billion or $6 billion, I'm not willing to use that to underwrite the business for the next maybe 3 to 5 years to maintain this very expensive cost base, because we ain't going to be the remuneration is going to be limited until we break the high watermark. And truth be told, that doesn't look as if it's possible. So to continue the business as it is, it's going to cost me. And heads I win, baby. Tails I win, baby. I'm out of here. That's the message. So, Gabe, boom, you won, and we all lost. Tom, I guess given that you're still engaged in the business, you might have a different take on it, and I certainly would not wish to embarrass you. We can move on.
Tom, are you? No, I was going to say, Tom, are you heads I win, tails I win as well?
Well, I don't know about that, but I think part of the incentive structure of hedge funds is always to have a performance fee on the upside. And, the idea behind that is supposed to be to incentivize the manager to make money on the money he runs for the clients. And obviously, if you're so much in a drawdown, he can't promise that anymore. And so if you think there is some kind of, reasonableness behind that incentive structure, then it's very clear he doesn't have that anymore. He now has symmetry between upside and downside, which doesn't incentivize him to make money for his clients in the same way. Another one option could be, to give him the benefit of the doubt, is that he sees the investing environment today as very, very different from the investing environment where he made most of his money. We've had a remarkable boom in tech stocks, which haven't really had to create much profit. They haven't really had to invest a huge amount in physical infrastructure. They've been insulated by very low rates. They haven't had to worry about inflation. Now, of course, there's a possibility that the investing environment, which led Gabe and others to become superstars, has turned on its head, and as a result, he doesn't think he can make money anymore. And so, maybe he's doing it. Maybe he's got his client's best interest at heart. I don't know, but there's many possibilities for what the reason could be.
Well, is there a danger? I was going to ask you about Chase Coleman, because Chase Coleman's a big name on this show. Not only do we like him, last year he was the third biggest earning hedge fund manager in the world. He made $2.5 billion, but his hedge fund has lost $17 billion this year. And him and his Tiger Cubs, I think it was a headline saying Tiger Cubs will get mauled. Quite a few of them are down 27%, 32%, et cetera, et cetera. So if someone like him was to go, is it possible someone like him, as high profile as him, would do this? Because Gabe's not quite got that same level of stardom. Could we be looking at Chase Coleman, and would that be a watermark that might see a lot of other hedge funds sort of fall by the wayside?
Well, I think Melbourne was always known for, running pretty high leverage, pretty high vol. And has been in trouble recently, was in trouble last year over the whole GameStop thing. And so, he's basically been double tapped. Whereas for a lot of these guys, they're still on their first hit. So like a lot of these big names have become very, very difficult to buy into. The only way you can get into these funds is to enter into very long-term lockup agreements. And so, I think it takes time for these guys to lose the capital that they've got under investment. Even a typical kind of redemption schedule for some of these hedge funds is like 3 months long. And so, if an investor kind of saw what was coming in February, they might only just be getting their money now. And so, I think the redemption story is going to continue. And obviously on the other side of it, a huge amount of capital is needed in commodities, in kind of, physical infrastructure type plays, which is, the other side of the coin to the guys who made money in the last bull market. So I just think it's an indication on the state of the market. It's always the guys who made the most money in the boom are going to lose the most when the economic situation changes.
And, so with Tom and the danger of being tarred all by the same brush, these particular managers that we're talking about, they are famous, celebrated, and now somewhat notorious for the bravado in the use and application of leverage, and which creates volatility, which accentuates gains. But the double-edged sword is that when they are off target, it can be profoundly damaging. Now, there is transparency in that. There are supposedly adults and a huge professional skilled network who are making manager selection decisions and should be aware of that. And they're also should be aware of 3-month or extended lock-ins in terms of the repatriation of capital. So it's not like we're not saying that this is dastardly deeds by these particular named managers. Why would you not? Why would you? It would be profoundly silly not to play the system in the manner that it's set up to do. Now with Tom's doing something very different. He is very much determining levels of volatility, which is to say levels of risk engagement, and trying as best as possible. At the end of the day, it's a calculated guess with regard to the footprint of losses that you're likely to make, but it's easier to define, if you will. And Tom would have a risk procedure which would shut down risks. So he's not asking clients to underwrite. So with Gabe et al, for sure, there's a blank check to accept a kind of 20% drawdown during the year as you reach for the stars. Tom's model, Tom, I'm talking for you. We should hear from you, but my understanding is that you're calibrated in a less spectacular kind of ebullient manner.
Yeah, no, that's right. I'm sort of in the macro game, and so I'm not. My thesis adapts and changes as I see the economic cycle, and so the hope is that in major turning points, it's not something which hurts you. I guess if you are sort of like sailing in a little bit of sea, the waves buffet you from side to side, and every now and then a tidal wave comes out. I guess, the purpose of what I do is to try and work out, don't worry about the waves, don't claim to be an expert on it, but just watch out for where the tidal wave is going to come from. And so, so hopefully, the things which other people see as exogenous shocks to their risk profile are things which I can actively pursue as opportunities. That's when it all goes well. Of course,
yeah.
No one has a crystal ball, and having a strong risk framework to be able to kind of allow you to course correct when you go wrong without losing too much is just as valuable as being in the right trades, really.
Let's play with that.
Sorry, when you go here. No,
let's play with that, because we can riff with your waves, and you're on the outlook for the dangers of tidal surges, if I summarize what you were saying. And so for the past several months, more like going back to last year, we had been noting the rise and rise and rise of the 10-year Treasury bond yield from the lows which had been set during the great uncertainty and fear of the COVID crisis back in March 2020, where there was a great willingness to effectively take no commercial risk. And so the treasury is deemed to be the risk-free security, and it priced near zero. And what we saw by extension of that cultural desire not to take risk was that for those who had to own equities, there was a clustering and a bias in favor of these mega large caps, mega large tech stocks, the Apples of this world, which were deemed to be risk commercially. And this is all relative in the world of blind people, the one-eyed person in the world of blind people. But Apple would be deemed to be Apple, and its ability to gain the status of the first $2 trillion cap stock, $3 trillion cap stock was effectively the celebration or the absolute denial, the lack of willingness to embrace commercial risk. And these businesses were deemed to be the least commercially risky. And so what we were seeing is that trend on the observation deck in looking for these tidal surges, we could see things changing and things becoming unmoored, untethered, in the sense that the 10-year treasury eventually moved from, let's call it 50 basis points to 300 basis points. And we would know that would have consequences. Looking at these meteorological surveys, if you will, the only interpretation that would seem fit would be the desire and the appetite to take commercial risk is greater, and therefore there's going to be selling pressure on these tech stocks. And then on top of that, I guess from a risk parameter basis, we would be concerned about, heavens, if any of these stocks demonstrate in their earnings releases that they are less than saintly, which is to say, if they reveal mortality and that their businesses post the lockdown actually reveal a degree of cyclicality and fail to meet expectations, then it could be quite a bloodbath. Now, that was the shipping news, and that shipping news has been kind of well reported. There've been bulletins, if you will, every week. And yet that's the same period where these tech and aggressively leveraged tech funds have blown up. So, that's where Tom would be, you'd be looking to put an overlay on that environment. And I know Tom has had a kind of an inflation bias, and his funds have been making money despite that crush in those stocks.
Yeah, no, and I've got to say, actually, Hugh, I've been surprised by the extent of the large cap tech sell-off. Like, in a way, I sort of thought in an inflationary market, if there's one group of companies who can retain pricing power, it's large cap tech. Because we talk about higher nominal interest rates, but we can also look at real interest rates, which are still relatively low. If you can, if you can increase the price of your services in line with inflation in the economy, you shouldn't really take that much of a hit on your future expected cash flows. But I think what the surprise has been to me is that as an industry, from the bottom up rather than from the top down, there's been hits as well. It's sort of, you look at Netflix, it seems they've basically reached saturation, and are now sort of entering into the ad market. You've got Disney doing the same. The ad market, I feel, which is basically what a lot of these big tech guys rely on. That's what Google relies on. That's what Facebook relies on. Is becoming saturated. Our eyeballs are becoming saturated with ads, and all the while there's more and more people trying to sell ads and sell eyeball space on our behalf to try and get us to buy stuff. And I think that stimulus, on us as human beings, is diminishing in its impact. We learn to ignore the ads. We can differentiate. We can go, we would rather go somewhere else where there are less ads. And so I think, there's the macro story about rates, but at the same time, what's hitting these guys is from the bottom up, is that I think we're reaching that saturation point in terms of advertising, and those guys, as a result, are underperforming what you'd expect from a pure macro perspective. And obviously that's really bad news for the stock market, because, the one group of stocks who ought to be able to, keep up with inflation can't, because the innards of their business model is being disrupted. And as a result, all you've got left propping up the market is a very, very narrow group of companies who are basically solving supply chain and commodity supply issues, which, as a percentage of market cap are really, really small. And so, even if those companies continue to do well at a larger index level, you can still see a lot more damage.
There were two things going on, but again, if we go back to just the carnage in the stock price performance of these fallen darlings or angels, there was a kind of negligence with regard to just how specific and how unique that kind of 18 months of lockdown was, and that whatever observations, positive or negative, that were experienced, they really, to be valid in the long term, they had to survive at least the 18 months after COVID. And so obviously the Pelotons, the home delivery stocks, and to a degree Netflix, failed that metric. But the surprise for me is that, some of these savvy investors were not kind of saying, actually before, after, and after you become a show me again. But on the tech thing, on top of that pricing franchise and the robustness to deal with a different environment, of course, the other thing that was going on was, as they were priced as deities, as just the pinnacle of excellence, they got high on that supply, and they committed to profound investment spending. And it would seem that they've all got that message now. And that's something you can immediately rectify. And I know you were sharing with me a piece, because I think it's appropriate we discuss that piece, the piece which was saying that in terms of valuation, both absolute and I think relative to markets, like in the course of their history, they've never been as, and I hate using this word, I was going to say cheap, but they've never been as lowly rated as they are today. And then there's this kind of this very obvious self-help mechanism, which is, well, just stop, like, Facebook was committed to spending $2 billion on expansion. It's like, we've changed our mind. Our stock price is down 65%. So where are you on that paper? Because it would seem that Gabe has rejected that thesis. He's like, you would stay in the game on the basis of that valuation metric, the notion that mean reversion would potentially bring you back into the sphere of being able to challenge your high watermark.
Yeah, like the problem is that, their margins and their profit growth has just been bulletproof until now, right? And it just seems that, Apple made the cookies stale that crumbles the profits into their lap, and basically, stopped them from being able to track as much. It just seems there's a ton of different things going on, all at the same time, which are kind of hurting their ability to make money. Maybe like, I think when this is all over, they're still going to be fantastic companies and they're going to be great buys, but I'm just not sure we're there yet. You still have a Fed which seems very, very keen to hike interest rates again and again. And we've got, S&P is now down 18% on the year. We don't seem to have seen any change in behavior from the Fed. We don't really know where their intervention level is. If we don't hit their intervention level, the likelihood is that rates keep getting hiked and these companies continue to get hurt. Because I think what what guys like Melvin Capital and others have always relied on, and they've been right, is that rates never get meaningfully hiked. The Fed always kind of pulls away as soon as the equity market has a meaningful correction. We were looking at the chart of drawdowns in the S&P 500 index of stocks earlier, we're now, we're getting on for a 20% correction. In the COVID period, we saw, I think it was just over 20%. In 2018, we saw a correction of around 20%. And that was enough to cause the Fed to change tack. They've been so we're in the third big correction since the great financial crisis. And for the first time, the Fed does not seem to have got the back of investors. Where is the pain point? That's the question. We just don't seem to have realized it yet. And so I think that's why you've got these guys giving back the money, because they don't understand, they don't know what the rules of the game are anymore. They don't know what the parameters of the model are that the Fed and the government interact with the economy. Maybe we're only 5% away from a change of tack from the Fed. I think it's probably at least 10. So long as, the jobs market holds up, tax revenues are holding up, there doesn't seem to be that much sign of damage in the real economy. So far, as far as I can tell, it seems to be a financial asset hit rather than a recession in the real economy, which looks more like 2000 than it looks like 2008.
So Chris, I think that's an appropriate.
Sorry.
Yes, an appropriate. Yes, I was thinking it's an appropriate point because we had maritime references.
Well, we did we're bringing it all together. But one thing I did want to say was that Tom talked about eyeball saturation, and if I am correct, this podcast, this production is ad free. We people are not selling out. Even if Spotify come with a Joe Rogan $100 million check, we are leaders. We are not joiners. Am I right, Hugh?
You're 100% incorrect. I am just waiting to monetize whatever eyeballs are left.
Yeah, but we're joiners. We're leaders. We're not joiners. We don't need to sell out to them. Anyway, that's not the point right now. We have a nice reference from one of Hugh's monthlies. So I was looking back in October 2008 and tying all this together. Hugh picked the enigmatic French footballer by the name of Eric Cantona, who once said, "When the seagulls follow the trawler, it is because they think sardines will be thrown into the sea." And that's where we stand right now, Hugh, and you're feeling we can adapt that quote from 95, which you quoted in 2008, to today in 2022.
I believe we can. I think that follows back into what Tom was saying. I'm going to give you a heads up. I'm hearing beeps in my headphones. I think the battery is going to expire, and I'll persist until they go. But if you see me, that's why I'm walking around. So I like that reference point in terms of, so for me, that would be the opposite of bond vigilantes. It would be the application or coming in and asset allocating in favor of 10-year treasuries because you can see offshore. So like Tom was saying just now, it's not that evident, but you can see offshore. Again, weather patterns, and you're looking at the damage essentially in collateral, and this is a collateral based economy, which is to say that we have debt levels which tower above income or GDP, and Tom's been very good with me over the years to say, is that the right metric? Because actually, without a doubt, the thing that distinguishes us from previous generations is we've become, as a society, wealthier. And so a wealthier society would naturally be inclined, and it would be optimal to seek higher levels of debt. And so just looking at debt to GDP, you kind of might miss it, but it's still relevant. I think we're about 4 times, and that is historically, it's high. And again, to Tom's point, financial innovation and prosperity push you that way. But if you start unpicking and unraveling collateral values, so again, we'll share the charts that Tom prepared earlier, and he has drawdowns for the 10-year treasury. And sadly, that data, Tom, I don't know can you get that data further, but your data began 2001, so 20 years of data. Obviously, we'd prefer if it was 40 years. I can imagine what the course of it would be like. But the losses suffered in the last 18 months in the treasury market are many standard deviations beyond the norm of the last 20 years. And so collateral, fixed incomes would like taking it. And remember, because fixed income has such traditionally low daily price volatility, financial agents are typically, they're not delta one long, they don't have funds of $1 billion and they buy $1 billion of treasuries. They might buy $10 trillion of treasuries. So we live in that kind of world. So the drawdowns that we've seen have destroyed a lot of collateral. And then we're talking about broad indices across the world being down 20%. So it's another haircut. And then again, we're talking about maybe another 20%. So these are things which actually then potentially can throw the economy off its perch and would validate the notion of a brewing and quite an enormous, like a hurricane type force of pressure, which if it hits the ground would take the economy down 2 or 3%. That's a lot. That's big. So if you will, speculating and now seeking to buy treasuries on these very, very deep drawdowns would be the seagulls, and the sardines would be them looking for these signs. So what are the signs? The sardine signs would be the collateral damage. It would be the Target and the Walmart statistics or missed earnings. Tom, again, we'll have a back and forward in terms of, is that margin compression? What does it say looking forward? Is it company specific, or can we amplify it to the level of the economy? And then the other thing would be looking at like discretionary consumer stocks, airlines, ship cruising companies, restaurants. The list is endless. Again, the stock market is not saying that these businesses look strong. They're saying that under the cosh of these discretionary items like filling your car up with gas, you've got less and less to spend on a discretionary basis. So these are sardines. I put a thread out last night, and I was saying, the TLT. Now, TLT, Tom, correct me if I'm wrong. It's an ETF which tracks. I want to say the price, or is it total return, Tom? Do you know, is it total return or just the price? Either way,
it depends what mode you've got it. You can look at either.
Okay, so I've just looked at it in the.
You've probably just got price.
Term.
Price would be standard.
Yeah, price standard. So that's fallen from 185 to 114. The ARC, Kathy's ARC fund per Kathy has fallen from about those levels to 40. But this is supposedly a risk-free portfolio, so that's severe. And I was saying, in terms of attempting to be a monkey and pick the bottoms in equity markets, I'd feel a lot more secure if I could start seeing the really super, super smart people come in and start bidding to want to own 10-year treasuries, because that would validate the voices in my head which see offshore storms. So Eric Cantona, seagulls, sardines, 10-year treasuries, S&P drawdowns. What do we do next? What do we do next, Tom?
Well, let me set the scene for Tom. I was just going to say that that whole analogy you gave everyone, but we didn't get who was the maverick French footballer. Now, I think we can all agree that he is the loose cannon in the blue sunglasses, people. I think we can all agree that is the Eric Cantona in this model. But Hugh's tweet was, if I'm a US household, my generation has been displaced by the PCCP. My credit card and buy now, pay later schemes have allowed me to just about scrape by. Except now, every non-discretionary item that my family needs to survive has just been repriced much higher. Walmart's telling you something. A, we're in recession for the many, not the few. B, it's just the beginning. C, higher rates destroy demand. D, but number one global problem is too much savings. E, Fed policy is nihilistic. And F, a short wrapping into load will follow. So mic check, 1, 2, 1, 2. This rate hike cycle don't feel real. Is it because it's premeditated? For the feel that the Fed are plastic thieves with no belief in what they steal? Don't ask me. I'm at the end of it. I pretend a bit of a misfit. I spend my days voyeuristic. Tom, name that song and please break down that thread for us.
I don't actually know what the song is. I probably should do. Okay.
I'd let you know what that song is, Hugh. What is that song that you quoted there? A short rapping interlude will follow, which I just rapped. What is that song?
So I can now hear again. I heard a bit of Earthling and the wonderful Radar album, which again I like Desperate Lost Causes, and this was a trip hop band from Bristol, and they had the misfortune of releasing in the same year as Portishead and Tricky, who went on to like global brief domination, and they were left behind. But in terms of poetry and super smart philosophical kind of leanings and observations of the world, it lives with me today. And so when I go off on one with these threads, I like to entertain myself a little bit. So that's where that comes from.
Well, that's the mystery cleared up, Tom. But yeah, please take us through what you think about that tweet and that thread, and what's your thoughts on it all.
Yeah, so well, in some ways, I think it would be better for Hugh to go through it, because I'm not sure I completely get every part of it. But I think what Hugh is trying to say is that the need for US households to kind of fund US government debt is not there anymore, because there's so much foreign demand for those assets. The PCCP. Well, the CCP is the Chinese Communist Party. I don't know what.
Say that again, Tom. Forgive me. What the US?
Well, you said my generation has been displaced by the PCCP. My credit card and buy now, pay later schemes have allowed me to just about scrape by. Except now, every non-discretionary item that my family needs to survive has just been repriced much higher. Well, I'll give you my take on that. So, if we look back, particularly at the world since 2003, people say it's a banner year. China entered the WTO, and we started to rely on them more and more to produce the consumer goods that we wanted to buy at a much cheaper price. So the US consumer kind of invested indirectly in infrastructure in China to produce consumer goods at a much cheaper price, because labor was cheaper mainly. They made a lot of money. They reinvested that money back into US treasuries. So despite the loss of industry in the US, there wasn't really a financing issue for the US government, because instead of being able to tax, US industry, and kind of, getting them to sort of fund government deficits, they financed, the Chinese, for the most part, self-financed, but they invested the money back into US treasuries, because they had a closed financial system which couldn't cope with the inflows. And so basically we managed to export consumer goods production to China and did not have to pay for it. The problem is now that system is kind of broken. That system is based on global supply chains, kind of just-in-time deliveries, all of that jazz. Hyper efficiency. Everything has been about the price, because that's all that mattered. Because basically, why bother with anything else when you know that the Chinese are just going to come in and finance your government? No hassle, right? The problem is the system is broken. Supply chains are bust. The Chinese don't seem to be capable of producing those goods and getting them to us at the prices which we expect, and hence the system has kind of broken. We're seeing this massive inflation across the supply chain, and we no longer have the industrial capacity left to kind of replace it ourselves, which basically means the price of everything goes up, and there isn't really that much of a solution. And so then the question is, what happens next? What happens next in Hugh's thread is a wrap. I don't know if what happens next Hugh can answer. as in sort of in words, as opposed to sort of resorting to lyrics instead? I don't have the answers here.
Ooh, la. Yeah, ka-ching, ka-ching, ka-ching.
That was beautiful, Tom. I love that. That was a nice little sharp barb. That I liked it.
I can't even remember what I wrote last night. So I take exception. I do not believe the US entered into a contract where basically accepted a perpetual loss of income in return for perpetual financing. I believe that there was a short-term arrangement given a kind of heads of state agreement that China was so significant, and that there was a belief that a richer, more prosperous China would be a less radical China, and a richer China would enrich the global economy as opposed to just enriching itself. We accepted that it would the first stage would be taking it out of despair and out of dependency. We rapidly passed that, and the last 20 years has then been kind of China through, really great, fantastic execution, taking it further and further and further. But I rely on the genius of the market economy. And I feel that China is now at this level where it doesn't require kind of special status, that it is a powerful sovereign, one of the most powerful sovereigns in the world. It does not have a dependency. And it's now time for it to act like a grown-up and a reasonable global citizen, which means you've got to open up the current account, because what we've been left with has been a permanent slide in incomes. And like I say, I don't believe anyone signed off on that. The notion of the market and the comeback would be that the profoundly excellent execution of the infrastructure, which allowed you to move peasants toiling, fields with no fertilizer, and bring them into, space age modern metropoles with, again, amazing infrastructure and with $1 billion of capital, factories in the surrounding communities. That should have manifested itself in a higher level of the renminbi, which is to say, foreign investors should have been, the Chinese economy should have been open to those trade flows, for the globe to participate in what would be wealth creation. But more importantly, the people who've been neglected in the conversation are the ordinary folk, the Chinese citizens, and let's say it's just two tribes just now, the US household and the Chinese household. Both have been busted by this arrangement, which I would say doesn't have an economic compass point, but it's why I put this P in front of the Chinese Communist Party. It's the prolongation of a regime, a non-democratic regime. And it's willing to have citizens suffer to underwrite the prolongation of its tenure. So those citizens are suffering because the renminbi, which is now sliding again, is weakening. It looks as if it's moving now. It's lost this anchor of like 630, 640. It looks as if we could trade 720. If you trade beyond that level, then people start talking about 9. So then you talk about a serious deval when my system, the system that I understand, suggests that damn renminbi should be trading closer to 5, if not below 5. So the failure to establish a market price for the renminbi is removing a source of demand for the global economy, and the source being endogenous Chinese growth emanating from richer, more prosperous Chinese households spending more and actually being given like social security backlines, health provision backlines sponsored by the state, so that savings levels in China can actually come down and support consumption to GDP levels in China are off the chart in terms of being way below where you would expect an advanced economy of China's status. That's the lie. So the Chinese household has got it in the ass. The global economy has got it in the ass because we don't have, if Chinese consumption went from, I'm going to make this figure up, but let's say 47% of GDP to 65. Wow. The difference that makes to the global economy. What is the difference? The difference is, and again, if that's happening with renminbi being at 5, you can be manufacturing in the US. You don't have to outsource. You insource to the United States. You employ people, and the source of your demand is China. Okay, that's the market is not being allowed. It's being removed by this heads of state sovereign agreement, which is leading to the poverty that we saw yesterday in Walmart. I go to Walmart because, I'm unskilled. Like my wage level is being dragged down by the presence of many more unskilled people who have been very fortunately provided with, a lot of capital formation and infrastructure. And that's dragging me down. I go to Walmart because I've got no choice. I've got credit card bills because the incoming is less and less versus the essential outgoing. I'm taking buy now, pay later, just to keep me alive. And like I say, that was before, we had this commodity price inflation. And now I'm just like, well, my expectation is, because what you see is since the COVID checks and you were able to restore some balance and just get all of these credit card bills down, they're off the charts. And so it's a cyclical chart, the chart of credit card balances. And if they reverse and they start coming back down again, that's my offshore economic recessionary storm. So interest rates, I'm going to stop there, but I don't think interest rates and higher interest rates are the solution just now. Tom, where am I? Was that too much beat poetry? Was that too much Jack Kerouac for you?
No, that made sense to me. Like, so I the remarkable thing for me has been that I sort of thought that China would just eventually become more democratic as a result of this. They would open themselves up to further consumption, and would revalue the RMB higher versus the dollar, and that's how all of this would end. It's seemingly that view has been far too optimistic. And instead, what seems to have happened, going back to what you were saying before about, like China has basically been stealing our jobs, but they've also been paying our taxes through, essentially just parking money in US dollar assets. But the problem is with that is that, the source of government receipts starts to diverge from the people in the US. And so it seems, China has gone further and further down this road of refusing to open itself up, both on the capital account side and to kind of rebalance their economy towards the consumer. As a result, they have had no choice but to buy US dollar assets. Most of that basically ends up in the US Treasury market, which divorces US government financing from the people who vote the government in. And, arguably, this is just another side of the issue that we're facing in the Western world. It sort of feels like the whole thing has kind of spiraled out of control. We still live in a democracy, but if money buys government as well as votes by government, and China has to an extent corrupted the political process in the West rather than we have sort of opened up their political process. And I think there is a big recognition now that this has kind of happened. We can see, it's all very well until you lose control of your supply chains and prices start going up. And, now we're seeing China basically in a recession of its own making, in a state where they have overinvested internally in their own property market to the extent at which to open up now would be incredibly dangerous for them, because you can look at relative FX value. We talk about what is the level, what should the value of the yuan be. There are two different ways you can look at it. You can look at it from a current account, like a flow perspective, and from that basis, there is no doubt that the yuan should appreciate versus the US dollar. But if you look at it in another way, if you look at how much do assets cost in yuan relative to the same assets in the US, and you look at the cost of property in China relative to the cost of property in the US compared to income, it's extortionate. And so, to my mind, despite the fact that the current account would suggest a much stronger yuan, if you just open the capital account today, huge amounts of money would want to leave China. There would be a forced repricing of that hugely overextended Chinese property market, and we'd see a collapse. The problem is that doesn't really solve the problem, where, so it almost seems that the yuan has to sell off first. You have to correct the capital imbalance first, and only then can China open and
so Tom,
you rebalance the current account.
What about the solutions? Because I talk to myself on Twitter. The solution of so I get that. I absolutely, with the perilous overvaluation, and then of the property sector, and then the self-harm. I mean, the PCCP are basically kind of ripping off the mask and saying, "We fooled you. You thought we were going to be democratic by now. You got it wrong, you bozos, you idiots. We are the rulers of China. We will be the rulers forever." It's like, ooh, okay. So again, let's think about this. This has consequences. So the consequence, you're right. You can't upset the apple cart. You can't just say, F you sort of thing. The Trump administration had a sense of this, but going into trade and trying to affect trade flows directly, we know from history, it's a dumb idea. That again, we all come down with it. So again, we're seeking solutions. So I put it to you again, what I'm going to say, but so we can't open them up, right? Because they've got this vulnerability from the property, and it's of their own making, but they've got this vulnerability and it could affect us. But why not have the withholding tax on those treasury holdings? What's the fault there? What's the negative consequence that I'm missing?
Well, you haven't needed the withholding tax up to now, right? Because you've had essentially a guarantee that China will just finance US debt directly. And so there hasn't been the need to tax them in a way, because they're basically already financing your government. Yes, you can kind of say,
well, hold on. You need to tax. Hold on. You need to tax them because we revealed the big lie that, for 20 years, we accepted a reduction in our earnings capacity paid for by, the capital account. But it was temporary. It wasn't meant to be permanent, right? And so it was on the proposition that they would be lurching towards the proximity of democracy by now. And clearly that's not going to happen, right? So that's what I'm talking about. So that has consequences. To my mind, it's now like, well, you're kind of failing to deliver. We appreciate the financing, but actually we need a stick. And the stick is, I say 3% withholding tax just because treasury yields or nominal rates are 3%. To my mind, I think this is not a hedge fund. This is not a commercial entity. This is an entity that its only priority is the prolongation of staying in office. And if you say to me, I've got to pay 3%, what is that? That's $90 billion a year. Done, no problem. What are the negative? you do that, and how do you change the world? Like what are the bad things which I'm missing? Because clearly there are many.
Well, let's explore that. So can you just first of all just say, so this withholding tax, is this something which is paid? Is this an annual tax? Is this an exit tax? Is this an entry tax? Because I think the ramifications of it are different depending on what type of a tax it is.
It is annual as long as you seek the safe refuge of a democratic nation with contract law where property is respected, where you have the Fed basically underwriting, whereby and believe me, they are, this is one of those points that there are problems in China just now, and they are selling treasuries. That's part of the deal. Like when it's tough back home, you've got this ocean of liquidity. And if, God forbid, if there's no liquidity in that ocean, like there was in COVID, don't worry, we got it. We're your friend. We got the Fed, and the Fed will give you an exit, okay? And I'm saying, but guys, we've gone the extra mile. We will not countenance you making a positive return annually on those treasuries. So as long as they're there, we're going to impose a withholding tax charged annually.
On just non-US citizens or on sort of hostile countries, like who pays?
On any, I would have to make it blanket. Like sovereign holdings with the New York Fed as custodian, I would be imposing a withholding tax.
What if you buy corporate bonds, equities?
Okay, I would. So you're saying if that happens, then they're going to switch. I would say.
I'm asking you, would you include them?
Would I? For the moment, I wouldn't, because I don't think I don't fear a switch from treasuries to those instruments. And the reason I don't fear that is they do not provide the liquidity valve. See, these are a treasury holdings by the Chinese are a rainy day fund. They will sell them down when they have a liquidity crisis. The renminbi's weakness from 630 to where is it today? 675, 670, 675, right? That is not, okay, I am not saying that is cunning Chinese bureaucrats seeking to kind of gain an advantage because their economy is weak with COVID and property, that they're gaming currency. They're not doing that. There is presently a liquidity crisis brewing in the banking sector. The banking sector in China is the same as the global banking sector. It relies on dollar, treasury bill, collateral. And there is an increasing shortage of that. I believe that's my presumption. And that's why you own treasuries as a sovereign, that when you get the call from the banking minister, it's like, okay, no problem. Okay, sell me, so this, Tom, what was it? The period, was it 2012 to 2015 or later when they sold down $1 trillion officially of treasury holdings?
It was 2014 or 2015, yeah.
Exactly.
Right. I think the first thing that would happen is corporate credit spreads would absolutely collapse. If you're Apple, you basically get to issue $1 trillion of paper at a discount to US treasuries. There's, the problem is you're gonna struggle if you just did that on treasuries, and you've also got, you've got municipal bonds. Are they included? I think what happens depends on how leaky the system is. Like I would say, if anything, it would, so probably yields would decline on treasuries. Yields would massively decline on corporate debt.
But you're ignoring my point. I'm saying to you, they won't do that because the secondary market in Apple debt is not underwritten by the Federal Reserve. And therefore, at moments, Apple presently has had a mean reversion event. The stock price has fallen to its 20-month moving average, which is to say it's fallen 25%. I think more than likely it will probably fall to its 40-month moving average, which would take it nearer to like 110. In that environment, I would not like to be the Chinese policy, the PCCP's policy, I think would be put in peril by the ability to come in size and get filled to repatriate those dollars back and again, then you'd have to the PCCP would have to take if they succeeded in selling yards worth of Apple debt, they would have to then transfer it into the treasury market to then to resolve the shortage of collateral that they're facing in the banking system. I don't think treasury. I don't think corporate US debt markets are deep enough to support that sovereign mercantilist behavior.
I think likely a combination of other Western markets and US corporates would just absorb most of the slack. Let's say it didn't. China pays up. Maybe it does. Maybe you would have thought it should eventually incentivize them. It lowers the bar for them to shift towards a consumption economy.
Exactly.
I don't dispute that. It has to. It does seem like something needs to happen. You've seen, so Australia has this system whereby if you're an Australian pension fund and you purchase Australian shares, you basically get a tax rebate. And you used to have this situation where Rio Tinto and BHP Billiton had two non-fungible lines, one in Australia, one in London. I think one of them has been closed now, if not both. And you ended up having the Australian listed line, which had access to the exact same economics, but the only thing that was different was different tax rules if you are an Australian pension fund. It traded at a 20% premium to the London line, despite, as a foreign investor, they were exactly the same. As an Australian investor, they were not. And so because of that, the Australian line ended up trading at a massive premium. I guess if if what you're talking about distorts the market enough, you would have some sort of a similar impact. That's why I think you'd see kind of quasi treasuries, which are not subject to tax, trading at a premium relative to actual treasuries. I agree with you. The liquidity isn't really there, but at the same time, China needs some liquidity, right? I can't remember what their reserves are. You probably know. You probably got the number. Ah, shit. Sorry, my.
I loved it. You probably said you've probably got the number. Boom.
Chris was getting bored. He's like, I'm going to take him down.
Sorry, and just let me try and fit.
No. Well, we'll talk amongst ourselves. Chris, how's it going?
Not bad, not bad. Well, I was going to ask you actually that I was going to come in because there's a bit in your tweet here. It says, reset the global standard, insist that in mercantilist nations pursue endogenous growth. And I was wondering, because this is quite technical, I wondered if you could put meat on the bones for that. How would that look for ordinary people in these mercantilist nations? If you think that's interesting or not, I don't even think that's a valid point, but I thought it was a valid point.
Again, anyone who reads these threads, they're meant to be riddles. I'm not writing. Clarity of thought is wonderful, but there's no clarity when you're talking about these things. It's you're kind of groping in the dark, and so let's make it entertaining. I try and write those things with an energy. So to your point, what I'm saying is, the renminbi, or the Chinese, it has all these silly names, but the Chinese currency, the lower the figure versus the dollar, it means you need fewer and fewer of the Chinese currency to buy a dollar. So we were almost at 6. You only needed 6, and it looks as if we're going back to 7. So you need more of the local currency to buy dollars, which means 6 to 7. It's what was that, 15% or something? So anything that you might have desires as an ordinary, Chinese citizen, which is manufactured in the rare times that it's manufactured in the US, it has a US cost base, right? It's become 15% more expensive. Whereas if the renminbi goes from 6 to 5, it's the opposite. Things are getting cheaper. And, we live in a world of engagement where, they might send all that stuff, but the containers come back and we can put locally sourced and produced products where local folk in the US and Europe earn a buck. Okay. Mm-hmm. So the endogenous growth is simply allowing the currency to trade stronger. You see this. Historically, the German currency and the Swiss currency, these have been they're expensive places for us to go to. I remember the Geneva airport Starbucks. It's like $20 for a shitty start for a coffee.
Yeah.
But the reverse of that is Swiss people are really rich. It's a bit like Tom talking about those lines of Australian stock where there's 20% differential. The high currency makes those Swiss citizens rich. Why are they rich? Because they have this manufacturing sector, which they continue to reinvest in. They've got a sovereign infrastructure system, which is, you've been in Switzerland, the trains run on time. The road system is immense. They have tunnels through mountains. Plus, they make shit. They make it at really good cost because they invest in productivity. They're rich, and so their currency is high. And China could be that, but instead it adopts the policies of a less ambitious kind of beggar thy neighbor country. So if you will, in some respects, I want to big up China. I want China to be more prosperous. But to get to that level, it has to be more democratic. And it's really resisting that at this point. And so I'm like, I need to nudge you. I'm not against you, but I'm against the elite, but I need to nudge you closer to the common goal of democracy and prosperity. Does that kind of...
No, that makes sense. And are we seeing that a bit? I mean, I know it's a very different circumstance, but what we're seeing in Russia right now with obviously the hellish things in Ukraine, the way they're being attacked, their currency, their economy, their rulers, their oligarchs, are we seeing maybe other countries like China looking at it and going, actually, if we don't embrace change, it could be forced upon us in some ways?
Well, I don't think... I take umbrage from the notion of attack. I see...
a noble attack. I didn't mean in a bad way.
But, No, but I see it as volunteering to engage in self-harm. That the rules are just so self-evident, and to my mind, there's clarity and it's common sense. Like it's a bit like the Ten Commandments. Don't sleep with the neighbor's wife, don't kill the neighbor, etc. Right? Yeah. And the Ten Commandments seem to have been cast aside, and so there are consequences, and those consequences get exaggerated. The Russians did not have holdings in 10-year treasuries. They had, if you will, this kind of fungible, mysterious. They had bank holdings in what we call the Eurodollar system, but globally, the world said, "No, we can't go to nuclear war with you, and so we have to have economic war with you to try again to nudge you back to the center, which first of all has this pot of gold called prosperity. But to open the pot, you've got to be democratic. So join us, have fun, be rich with us, or, we're closing it and the cookie jar remains firmly on the top shelf, well away from you until you respect the commandments. Tom, are you back?
Yeah, I'm back. Yeah, no, apologies. I think, just weird computer issues, but all good. I didn't quite catch all of that. I sort of caught the last part about Russia. Russia have obviously got out of, a long time ago, got out of most of US Treasury debt. But at the same time, they used custodian banks and their assets still kind of got confiscated. And the thing is, let's say Russia can, park their money in a sort of in an intermediary country. Let's say they park their money in China, or they park their money
Well, isn't a lot of it going to Dubai? Because I mean, I read reports a lot of Russian money and investment was now heading for Dubai. Whether that's true or not, but that's what I read.
Well, it's all very well, but like, you know, Dubai is just an intermediary, right? Like, you know, if they're investing in Dubai, someone else is basically investing in US treasuries on their behalf. Like, you know, the only places with the capacity to absorb that amount of money is the US and other democratically run Western countries. And so you can sort of like play this giant game of Jenga, but you basically end up in the same place where there is a limit to the amount of places where you can actually invest money. Yeah, let's say, okay, Dubai property prices can double. Like, I don't know what the value of the Dubai property market is, but I don't think it's going to be that meaningful compared to the numbers we're talking about, which is trillions of dollars, right? And so it's a drop in the ocean. It doesn't, and it's the same with offshore tax havens. Like, they are literally a drop in the ocean. And you can park money there in terms of property values, but if you summed up the property values of all of the major small island tax havens in the world, probably the numbers you'd get to in terms of actual holdings would be very, very low. Like, the value of those places are to mask where the money, whose money it is, and to kind of like provide an intermediary who invests on your behalf. Like, ultimately, it doesn't change the nature of the game, which is that you have surplus nations and you have deficit nations where people want to park their money. And ultimately, Russia can like shift around its holdings, but someone else is going to invest in the US on their behalf. And so, to a certain extent, Hugh is right. People basically don't have any choice. The Russians can invest via Dubai, but if everyone has to pay a withholding tax, ultimately that cost gets passed on to whoever is running the current account surpluses. Like, that's the nature of the game. It's the same with gold, right? Like, you can bid up if you have China or Russia decides to, buy loads of gold and bid up the gold price. Basically, all they're doing is paying a bunch of money to the people who already hold that gold, who then have to decide, okay, we don't have gold anymore. We've got something which is probably dollars, because, gold is a dollar denominated market. They have to park those dollars somewhere and they probably put them in treasury. So it's a shell game, right? It makes no difference. The fundamental reality is you have deficit nations. They're permitted to be deficit nations because people want a piece of their pie. So long as that remains the same, the system remains the same. And, people who run that system could choose to tax it if they so wish.
We've seen the crypto.
Tom, yeah,
sorry,
Chris.
no, sorry,
go, Chris, go.
Well, I was going to say there, Tom, we've seen like the crypto world sort of meltdown with this, like, the pegs, the Luna, the Tether, all this kind of stuff. Terra can't maintain the pegs, massive meltdown, massive problems, lots of money eviscerated. So Hong Kong peg to dollar, is that going to go? And if that goes, is that going to be a similar meltdown?
No, like I don't think the Hong Kong peg is going to go. What we are seeing is a test of the Hong Kong monetary system. And so basically, Hong Kong runs a dirty peg to the US dollar. The Hong Kong dollar trades in a range of 7.75 to 7.85 US dollars. And basically, to first order, they import US monetary policy. So if the Fed hikes rates 50 basis points, Hong Kong hikes rates 50 basis points. And the bit what's remaining is sometimes liquidity is at a premium or at a discount in Hong Kong relative to the US, and that's the so basically you match the rates, but Hong Kong matches the dollar's rates policy, and then sometimes despite that there is a desire to still preferentially hold US dollars or Hong Kong dollars. And so what happens is the Hong Kong Monetary Authority then use the balance sheet. They shrink the balance sheet if there is too much desire for US dollars, and you're starting to, you're hitting the weak end of the band for Hong Kong dollars. and they expand the balance sheet on the other side. So it's basically, it's a live experiment that's going on at the moment to show the difference between balance sheet policy and rates policy. Rates policy is imported, and then they increase and decrease the size of the balance sheet to basically keep the FX within its accepted tradable bounds. And so what you've seen at the
Tom, the balance sheet, just to keep people with us, is so they have the Hong Kong Monetary Authority has a war chest of US dollars. This is the balance sheet you're referring to? So
they have a war chest of US dollars, but like actually that's not really how the monetary policy system works. So what happens is, there's far fewer Hong Kong dollars in existence than there are US dollars. And there also is far fewer Hong Kong dollars than the Hong Kong authorities have in US dollars. They hold a huge amount of reserve assets relative to the amount of cash in circulation. And so basically, the impact of removing Hong Kong dollar liquidity is way, way bigger than the impact on their reserves. And so, basically, if they shrink their own Hong Kong dollar liquidity, what happens is interest rates start to shoot higher in Hong Kong. And so you have this kind of like counter-cyclical monetary policy whereby when Hong Kong is doing well and the Hong Kong dollar is strong, you inject more liquidity. When Hong Kong is doing badly, you remove liquidity. And the thing is, like, counter-cyclical extra liquidity is all well and good when China and Hong Kong grow faster than the US. But at the moment, that's not the case. And they're being tested on the weak side of the peg. And running counter-cyclical monetary policy when your next door neighbor is completely shut down and you have huge problems in your domestic economy is quite dangerous. And so there is a knock-on effect on Hong Kong assets. But for the time being, their policy is basically to hike rates to like, stomach churning levels to constrain domestic activity rather than to sell down too many of the reserves. And so,
So you're paying?
So I'm based at the moment, there's a discount. So Hong Kong rates in the FX market are lower than US rates in the FX market. So that means, and basically as this liquidity gets drained, I'm expecting that interest rate differential to disappear to zero.
How big is that differential?
At the front end, it's about 80 basis points difference. So it's quite substantial.
Oh,
yeah.
That's huge. When you say front end, what tenure is that?
Like 3 months.
It's 80 basis points.
I think so. Well, you'll have to dub me saying a different number. I'll tell you afterwards.
Yeah. But roughly the US rates are where?
The Fed rates are basically at base rates, right? So all of the differences on the Hong Kong side. So Hong Kong ought to be importing US monetary policy, but because there's such a glut of liquidity in the Hong Kong dollar, they're not.
Okay. Says me, like, unable to quote you where Fed rate, they raise 50 basis points. But Fed rates are 75 basis points?
Yes, that's right, yeah.
So if it's 80, you're saying Hong Kong rates are like almost negative.
Yeah, so Hong Kong rates are basically zero, yeah.
Zero, so no.
Yeah, but of course, this is over a 3-month period. So, the Fed are expected to hike 50 basis points in the next meetings.
Yeah.
So that would be.
So what goes wrong? What are you fearing in that trade? Where do you lose money?
The concern is that domestic liquidity doesn't get drained quick enough. So if the dollar versus the Hong Kong dollar comes off the weekend of the band, liquidity doesn't get drained. It's almost like a mechanical monetary policy system. You basically, instead of having Jerome Powell, you've got an algorithm which is determining monetary policy, and it's kind of worked very well. It takes politics out of the decision making process, but it does have this really nasty counter-cyclical edge, which, has never really proved to be too much of a problem yet. But, if things get, if China continues to slow, it could become a real problem. And, it could ultimately see the peg get challenged, because, if the yuan starts to depreciate against the US dollar, in a strong dollar environment, Hong Kong basically imports that very, very strong, it basically imports the policy rates from the US, which, at the moment, the US is kind of running hot. They're trying to hike rates. In China, they're still cutting rates. And so the problem is, over the past few years, Hong Kong has become more Chinese, but it's still running US monetary policy. And, as the divergence between those two things grows, the pressure on the Hong Kong economy grows as well.
And that spread between the rates at that tenor, historically, how wide is that? Is that like way wider than normal? Where are we?
So I think it's gone to about 1.5% in the past. The problem is I look at it in pips rather than percentage. So I'd have to double check the numbers. We're about half of where it's been in the past, but we also are right at the weak end of the band, whereby that liquidity gets removed. And so I wouldn't expect it to go to the levels where we have seen in the past, because, we're a hell of a long way away from injecting more liquidity, and we're very close to removing it every day.
Okay. So the good, I like that. But the overarching question, which we kind of danced around, was risk assets, predominantly US equity risk assets, in a drawdown. S&P, I think you said 18%. Again, I'll bring up a chart showing going back to the early 1970s, and we're trying. And one of the roles as a risk manager is like, where are we? Which size fits? And again, we touched upon my thread, which was saying, for markets to rally, I feel like you need the engagement of the 10-year Treasury, where the yield stops rising. If that's not the case, and I think you're more in the camp that you just think the momentum of the economy is such that it's difficult to envisage those rates coming off from 3%, then you kind of open up this kind of Cassandra world of deeper drawdowns, where you've got the footprint of COVID, you've got the footprint of the great financial crisis, and then I guess you've got the footprint of the NASDAQ collapse, but you've got that early 1970s one as well. And all of them are kind of 45% S&P movements. So maybe we should wrap by just trying to see how, like a risk analysis, where does that take us in trying to see the future?
Like, the way I see it is, the Federal Reserve basically told you what they're going to do. There was always a mantra in the 2010s, which is don't fight the Fed. I think that's still true. The difference is the Fed are trying to do something completely different to what they were doing back in the 2010s. And as a result, I would steer clear away from receiving interest rates until you see, well, first of all, you see like some sort of like price, you see the rally in yields going higher, sort of like tapering out a little bit, and you see more damage in the S&P, because as like, you've seen, we're seeing damage to corporate profits. Maybe we're seeing a little bit of damage in terms of retail sales, but that's based on very, very elevated retail sales due to everyone being, locked in. Yeah. And so I wouldn't, it's not really a huge surprise to see those retail sales numbers come down a bit, and I'm talking here in real terms. If you look at retail sales in real terms, they've come in a bit. But ultimately, where we end up is that I think that, when we talk about liquidity, like there's two things: there's quantity and there's price. The Fed are trying to increase the price of liquidity by putting up interest rates across the economy. You're seeing 10-year bond yields go up with expectations of more rate hikes. And so, liquidity is being repriced. But at the same time, there's enormous amounts of it. We're basically talking about hiking rates back to 3%, which is where we got to and failed in late 2018, right? The difference is, since then, the balance sheet has nigh on doubled. So, the Fed basically in 2018, 2019 tried to reduce the balance sheet on autopilot. It reduced it down to, I think, something like $4 trillion. It went back up to 5 trillion by the start of 2020, as they were basically forced to inject some liquidity back in the system in their like non-QE way. We're now at 9, and we're talking about reducing that down to 8 in a year's time. That's really slow. There's an enormous amount of liquidity sitting there. And I hear you. I'm not saying that the Fed balance sheet is as powerful as commercial bank money. But at the same time, like, it is there. There's a multiplier on it. Like, you're seeing there's enormous tax receipts on the part of the federal government this year, which is going to reduce the fiscal deficit. We're not seeing that balance sheet decrease. And as a result, the availability of liquidity is still going to be there. And I think that is, until that is addressed, rates probably will go higher. Like, I'm not saying, I think if the market goes down another 5%, probably the Fed will step away from these like 50 basis point hikes or whatever. But inflation is not going to go away, and they'll be forced to go back to it. Because I think, the consumer is resilient, because the consumer, unlike the last time we had a crisis, was bailed out massively. Last time it was just the corporate world which was bailed out. And, every time the consumer part of the economy got hurt, we had to like kind of go away from it. But this time everyone got a bailout. And I just don't see the consumer as being that weak. And so I think the Fed is going to be like, to hell with Wall Street. Main Street is fine. They've got plenty of money. And so it's financial assets that take the hit.
So why are we not, again, the challenge is, I always look for trace elements in financial markets to demonstrate proof of concept. So you paint a story of a robust, a healthy, resolute household sector that has been accommodated for by the federal government, and shows no sign of weakness. And yet, where I go looking for discretionary stocks, I see the stock market telling me that business is really bad.
So I think we've seen, the last decade, we saw stock markets massively outperform the real economy. Consumer staple stocks, consumer discretionary stocks, basically every kind of stock massively outperformed GDP, massively outperformed wages. I think the whole thing reverses. And so financial assets take the hit, and the domestic economy doesn't get hit nearly as badly. And so I think a lot of what we're seeing is just, it's not just consumer stocks that are getting hit, it's everything. Everything's getting hit together. Yesterday, NASDAQ, Russell, S&P were basically all down roughly the same amount. It's stocks as an asset class which are getting hit rather than individual companies. Like, I hear you, Walmart sort of was the catalyst, but I think it's a hit to financial assets more broadly. And, this is not to say, like, at some point there will be pain if the Fed keeps trying to hike rates. And at some point the consumer will get hurt, and a recession will be on the cards. I just think, that huge amount of liquidity on the Fed's balance sheet and the huge buffer to savings in the COVID response is going to cause a massive inertia in terms of when the recession comes. And so I think until the Fed starts draining the balance sheet, the economy is not going to respond very quickly to higher rates. Asset prices are going to basically predict a recession, and it's going to take a long time coming, which is going to encourage the Fed to keep going until the recession that we do finally get is going to be even bigger. That's the way I see it.
But you also see it in that the Fed is kind of hemmed in by its communication. This is what we're going to do, and this will take us to kind of what we were trying to achieve in 2018, and that kind of 3% level. And we're on the record of like $90 billion a month in balance sheet reduction, which is like a trillion rather, annually. And so the market has got that baked in, right? The economy would have to demonstrate, like your point, that it's more than robust for those rate points to go up. The fear is that maybe the Fed still thinks it needs to be pushed, to be slowed down more. It feels constrained on the rates, and so it doubles up on the liquidity withdrawal via the balance sheet. Can you say something about that?
Yeah, like I agree. I agree with what you're saying there. Like it's just I think there's this big inertia. It's almost like, the economy was like a car. The Fed slammed on the brakes, and there was rubber on tarmac, and it slowed down very, very quickly. Like, to kind of go along with today's analogy of boats and seagulls. I think the US economy is now like a boat. Slowing down a boat is a lot harder than slowing down a car. You're basically we're on a sea of liquidity, and the Fed is slamming on the brakes as hard as it can, and basically nothing's happening. And so it's just going to keep on pushing harder and harder. Eventually, we're going to go into reverse, and it's going to be a disaster. But until then,
well, I think because I like that, because I'm saying you're saying the Fed slammed on the brakes. The market slammed on the brakes. The market took rates from raised 10-year rates by 6,000% from 0.47 to 320 or whatever, right? And so I feel like the super tanking, it takes forever to damn slow the thing down. The pilots out on front, us, we've done the heavy lifting. We sent the message, slow the damn thing down. And then the captain wakes up, OG Power's like, oh my God, slow. I'm like, but we've done it already. No, hit it more. And which just means the damn thing is going to stop. And it's going to be like, oh, bloody hell. Now we've got to phone the engine room. Now we've got to pump it back up. We've got to get it moving again. Bloody the captain, we wish you would just stay in your cabin. But anyway, that's fun and games. Chris, I think we're well past duration, longevity of broadcasting.
We will end. Okay. You got to go. Tom's got to go.
Yeah, I've got to head.
Well, of course. But so Chris, bring it up. No. Are you going to bail now? That's fine.
I'm gonna have to go. Sorry.
No problem. Go.
I got to be somewhere. I got to be somewhere half 7 on the dot. So.
Go. Thank you very much.
Thanks very much, guys. Cheers.
Take it. Okay. So, as Tom talked about pain there, and JP Morgan themselves have referred to this as going to be a cruel summer, people. It's going to be a cruel summer for us all. So all I've got to say is hot summer streets and the pavements are burning. I sit around trying to smile, but the air is so heavy and dry. Strange voices are saying...
What are they saying, Chris?
Things I can't understand. It's too close for comfort. This heat has got right out of hand. It's a cruel, cruel summer, leaving me here on my own. It's going to be a cruel, cruel, cruel summer, people.